afternoon, everyone, and a very warm welcome. Thank you for taking the time to join us for the fourth webinar in the Shoonya webinar series. Today's session will feature a panel discussion with leading voices from across the finance and clean mobility ecosystem, followed by a Q&A session and also a rapid fire. As we look to scale India's electric mobility transition, finance continues to play a pivotal role. So in today's discussion, we'll explore how capital can act as a catalyst for scale, for innovation, and inclusion across the EV ecosystem. To begin, let me take you through a quick overview of the Shoonya campaign and the ecosystem we've built together so far. So Shoonya, as some of you may already know, is a NITI Aayog-led campaign focused on fully electrifying India's last mile and ride-hailing segments. The campaign works across three pillars: building consumer demand, recognizing industry leadership, and creating a pathway to 100% urban electrification. If we can move to the next slide, Tanishka. And through the three pillars, Shoonya has brought now together over 230 industry partners, has reached over 25 million citizens, and helped enable nearly 1 billion zero-emission rides and deliveries. This collective effort by the Shoonya partner cohort has already saved more than 1,000 crores in fuel and also avoided more than 100,000 tons of CO2 emissions. I would now pass it to my colleague Kaustav, who can help us set some context for the discussion today. Kaustav, over to you.
Thank you, Vaibhav. So India's EV adoption needs to increase if we're to meet our ambitious targets. Even just looking at our energy independence target for 2047, the sales penetration rates across e-two-wheelers, three-wheelers, and four-wheelers needs to be close to 90 to 100%. But when we look at the progress under business as usual, we see that that sales penetration rate is likely to fall significantly short of what we need. Next slide, Tanishka. There's a number of reasons for why that might happen, but one of the key things that we can do is increase the availability of affordable financing. And what that means is reducing the gap between the lending terms for EVs and ICE vehicles. Typically, what you see is that interest rates for EVs tend to be higher across segments. The loans tend to be shorter in tenure, and the loan-to-value ratio, or the percentage of the asset's value that's covered by the loan, also tends to be smaller. What that collectively does is increase the EMIs for the borrower, increases the overall cost of the asset, which can often act as a significant barrier to adoption. Next slide, please, Tanishka. Now, there's a number of reasons why that happens, and that's because EVs inherently might carry greater risks for the lender. When we think about the risk in terms of the probability of a borrower defaulting, right, a lot of the borrowers for e-two-wheelers and three-wheelers might be new to credit and don't have a credit history against which the lender can give them money. A lot of these might also be people who are using EVs to generate income through which they might repay the loan. And in that case, any risk with the technology of the EV or any risks that come due to the inability to operate that, maybe it's a lack of charging stations, maybe it's a lack of maintenance services, can become a direct risk to the lender being able to recoup some of their money. Now, in that case, there's a number of de-risking measures that are available. Could we stay on that slide, please, Tanishka? Thank you. There are de-risking measures that are available that have been tried and tested, and our panelists will speak to them in our discussion. Having a guarantor, strong collection systems can ensure that flow of EMIs to the lender. In case there is a default, EVs are actually easier to repossess because of the telematics data that they generate. However, one challenge does remain is that after repossession happens, it can still be challenging to secure residual value of those EVs. And a lot of that is because the secondary sales market for EVs is currently limited, and we lack a lot of data needed on the quality of batteries and how they degrade over time. With that being said, as the market matures, we are seeing higher quality products, reducing some of that technology risks. Legacy brands are now dominant across a number of segments, and that increases the confidence of lenders in EV assets. Next slide, Tanishka. Just doubling down on that residual value risk, because that remains a key barrier to financing EVs. We need to unlock clarity on this. Doing so will unlock ecosystem benefits, potentially resulting in financiers lowering financing terms for consumers, boosting adoption, and hence enabling OEMs to invest in EVs at scale and innovation in the technology. In order to do that, there are some fundamental things that need to happen in the ecosystem. Tanishka, on the next slide, we can see that government needs to take a number of actions here. The first and foremost thing that needs to happen is that we need more data on the batteries. And more importantly, we need to develop a standardized framework for understanding how batteries degrade across segments and across different conditions in India. Establishing those benchmarks will be very critical for lenders in terms of them evaluating how the asset might evolve over the duration of the loan and in what condition they might have to repossess it and what kind of residual value they might get for it. Once we have a better understanding of that asset quality, we need to double down on increasing and maturing India's resale market for EVs. Some of that just depends on the market maturing, but there are investments that can be made by the government to ensure that batteries in EVs are designed for circularity, that it is easy to reuse, repurpose, and recycle these batteries and capture value. But in the meanwhile, what's likely to happen is that OEMs will have to absorb some of that residual value risk through buyback programs, through extended warranties, and in doing so, making it easier and more comfortable for lenders to provide money for EV adoption. Now, with that context setting, I'm going to pass it to my colleague Ria, who will deep dive into many of these topics and the solutions that are being devised by our panelists. Over to you, Ria.
Thank you, and a very good afternoon, good morning to everyone joining in. We're extremely delighted to have such a strong panel and such high interest in a topic which is very dear to a lot of us, the question of how do we really finance and take the conversation ahead on scaling electric vehicles. In light of this, we have three very strong panelists who have committed their time today. I'm going to start with a short round of introductions to welcome our panelists. Firstly, we have Dr. R.K. Singh, the Chief General Manager for the Green Climate Finance Vertical at SIDBI. Sir, it's an honor to have you with us today. Sir comes with 3 decades of experience in the MSME development and entrepreneurship space, and he's been leading national and international initiatives to align India's financing with EV goals, as well as other green-related projects through all the work that SIDBI has been doing. Thank you, sir, for your time and presence today. We also have with us Ms. Aparna Agarwal, who's the Senior Vice President, Global Automotives Industry at the DBS Bank, based out of Singapore. Welcome, Aparna. Thank you for joining us today. Aparna comes with more than 2 decades of experience across consulting, banking, and has played a critical role in scaling global OEMs and EV battery manufacturers through CapEx and supply chain financing, not just in India, but also Southeast Asia and beyond that. So we look forward to your global experience, Aparna, in today's conversation. We also have Nehal Gupta, the Managing Director at AMU Leasing. Nehal is a well-known force in the Indian NBFC EV financing space. She has built a 150 crore plus EV-focused business and is working towards financing more than 1 million EVs by 2030. She also serves as the director for the Electric Mobility Financiers Association of India, which is a critical industry body trying to push ahead on all things related to EV scaling. We also had today Mr. Monish Vora, who was to join us, the Chief Operating Officer from BEFIN. But unfortunately, because of a personal emergency, he won't be here today. And we will be starting the discussion with our 3 panelists who've given us time. With that, we're going to jump directly into the questions. And this is something we've curated as questions, not just from within the RMI team, but also from a lot of the conversations that we've done with stakeholders across the spectrum. So just the first question, RK sir, I'm going to post this towards you and really request you to start with your thoughts. Question is basically, we've seen that accelerating EVs, and we've heard this from you as well, that it's not just a climate imperative. It's something that has to be done to transform how transport, energy, infrastructure, and finance is seen. It's a much wider change that has to come into the ecosystem. In your perspective, sir, how critical is the financing component in enabling the shift towards EVs? And we would also love to hear a little bit about how SIDBI is positioned well within this ecosystem to drive that change and be at the leading end of it. So over to you.
Yeah, it is a very important segment within the green financing. We have like at SIDBI, we have picked up 5 key themes. So energy efficiency is one, renewable energy is second, EV, e-mobility is third, circular economy is fourth, and adaptation is fifth. So so we feel that EV is an impetus, because while E and RE are getting uh, uh, support, right, in good way, the EV financing needs to be fast tracked also. So things have been happening on 2-3 wheelers, but the emerging segments like e-bus, ZET, and all are getting now priority or thrust. So these all need to be looked at. So what at SIDBI we had done, and RMI also worked with us. We tried to interact with more than 1,000 stakeholders to arrive at that what are the pain points and how do we convert them into gain points. And the few important things which emerged is, one is understanding the entire ecosystem um, in a holistic way. Second is building capacity of the value chain, both on the demand and supply side is very critical, because if you have to really talk about bankability, then bankability needs to be traveling across the mindset. So that is what we have been working. And third is structuring proper instruments to finance. And here comes the risk sharing facility, which is very important. Give Philip to financing. And while we have started a risk sharing facility for 3 wheelers, but we are looking at working out for trucks and bus segment. And we are discussing with stakeholders. So whenever these emerging areas are there, it has been our experience. Not yet tested, not yet validated, yet to get matured, innovative or emerging. You need to provide the comfort to the bankers and lenders in terms of somebody who can do the technical evaluation and give comfort that okay, this model seems to be the go ahead for financial appraisal. So and when the bankers do financial the say appraisal on the financing side, then provide backup through a risk sharing facility. So it is a combination of technical evaluation validation and then providing a risk sharing facility. What we have learned over several years operating energy efficiency side, like we have kindled the ESCO market in the country. We have found that this has really worked well. And till now, it is also working for EV segment on 2-3 wheelers and say passenger vehicles, 4-wheeler also. The idea is how do we use it and power the now emerging segments of ZET and buses. So I will stop here and maybe.
No, thank you so much, sir. That's a very comprehensive overview and really well taken on your point about the emerging sectors beyond the 2 and 3 wheelers as well, which are equally critical for the EV transition to happen in the country. Next, I'm going to pass it, Nehal, to you and also get your perspective on how do you see AMU leasing playing a role in furthering financing, and what's the overall role that you see financiers playing in pushing ahead the EV journey?
Right. First of all, thank you so much for having me as part of the panel, and exciting to see all the work Shoonya has been doing. We at AMU are building an NBFC that's focusing entirely on green financing for green energy and for markets that are not able to access finance easy. So the moat is an intersection between inclusion of finance for the bottom of the pyramid including and using sustainable mobility to uplift them. So that's what we stand for. And the 150 crores that you mentioned is the loan book that we're currently operating on for entirely servicing only electric two-wheelers, three-wheelers, both L3, L5, cargo, passenger, four-wheeler passenger cargo, medium and heavy commercial vehicles as well, which include buses and even the four-wheelers that take up to even 3.54 ton of cargo and payload. So the idea and ambition is very clear to finance up to 1 million assets by 2030, which, sing in tune with the government targets and NITI Aayog's targets that have been well published across the country. And how we see that industry grow is, of course, one is the supply side of it, where we have a bunch of OEMs, charging infrastructure players, battery players that are getting the ecosystem together for financiers like us to even have assets to finance, right? So it's a big synergetic play between all different stakeholders. I won't say financing is the most important, but of course it's incomplete without us, like we're incomplete without other players that are actually putting out assets on the road. So I think the first 7 to 10 years of any new industry, which was even observed in CNG and much before that in the transportation sector overall, in my experience, is that it takes up to 7 to 10 years for the industry to mature, to get it built up, and for even the secondary or resale market to come in. So we're waiting for that period to get over. We've elapsed 5 years in this space. We're looking for the next 5, and we are expecting a lot of mergers, consolidations, acquisitions to happen, which will, solidify the industry more. And the highest demand still continues to come from the commercial vehicle aspect, which is 2, 3, 4, even buses or trucks that are counted as commercial vehicles. So we see the growth is poised for commercial vehicles, followed by passenger vehicles, pan-India, of course. And the biggest push, like Sir also said, is in the two-wheelers and three-wheeler space, which is what AMU's focus area today is as well. And we look forward to sort of getting more assets as part of our book in the next 5 years. So yeah, that's what we're positioned as.
But thank you so much, Nehal. That's very encouraging to see the confidence that you have in scaling of this segment. And we certainly need more financiers, like I would say all three of you, who are so positive in their outlook towards the scale of this sector. Aparna, I'm going to come to you next, and you really come from a little bit of the global perspective, and would love to learn from where you sit. How has the EV financing landscape really evolved in the last 2 to 3 years, and specifically across segments like 2, 3-wheelers, LCVs, and also importantly, charging infrastructure, which is such a critical component of scaling the entire EV trajectory in any country?
Thanks, firstly. Ria, thank you for having me, firstly. So maybe I share, so on the EV financing landscape, as you said, right, as Nehal also just pointed out, that it is evolving across the segments, whether it is two-wheelers, three-wheelers, PV, CV. On the financing aspect, two-wheelers, if you see, had a limited bank financing in the past, and relied a lot on the upfront purchases or NBFC supported loans. But over time, with more experience, with more certainty on the lifespan of batteries and technology, banks have started offering green loans, green auto loans. NBFC support has come in at a cheaper pricing relatively from the past. Similarly, on the three-wheeler segment, which was earlier dominated a lot by the unorganized and, again, cash-driven purchases, but overall, over time, gradually evolved into a more organized way of financing. The ELCVs, the light commercial vehicles, actually that segment growth has risen in the last couple of years, driven by e-commerce, logistics companies, and OEMs, which have actually started offering bundled financing. That includes your maintenance, maintenance, and anchor-based financing. NBFIs and DFIs, back models, battery as a service models, these are evolving. Charging infra, as you rightly said, was earlier primarily led by government as pilot capex projects. But over time, governments are also raising funds through green bonds, public-private partnerships, leasing models. But if you see financing overall, right, in these segments has been constrained due to lower utilizations and residual value of batteries, the resale value of the EVs as such, and the land accesses for the charging infra. But I think over time, as more data comes in, more experiences come in, more certainty around the battery and the overall resale value, residual value comes in all together, this will bring in more clarity, better opportunities, and financing will follow that. I mean, just as an example, right, the ICE ecosystem that was set up, it did not get set up in a few years. It took it took several decades for that ecosystem to be set up, and the supply chains to be set up, the technology to be set. So similarly, the EV ecosystem also will be set up, and then it will become more standardized for financing to follow these segments.
No, thank you, Aparna. It's an interesting point you raise, how, just from government pilot projects, various parts within the EV value chain are moving towards more structured investment from financiers as well. And one thing that I did gather, sir, you also mentioned some of this in Nehal and Aparna, this landscape of institutional challenges around EV financing still sort of remains. And sir, I'm coming back to you at this minute. From your perspective, what is the most pressing challenge around EV financing that needs to be resolved? And in your opinion, what is the right way to resolve that?
So, the most important, as I mentioned, is the risk perception. It needs to be diluted and made understandable. To do that, one is from the aspirant side or entrepreneur side, there is a need to also sensitize or exposure to bankers need to be given so that they understand the bankability good way. The day that will happen, the lending becomes clear and all. It is faster. What we have also tried to do in the green space, which includes EV, we are operating gifts program with the Government of India, Ministry of Micro and Small and Medium Enterprises. This gift is green investment and financing transformation. That includes EV also. So what we have done is we have tried to standardize the plant and machine, the technology list, and it's a 890 technology bucket which is identified and which is clear enough for the appraising officer to know that these are standardized uh, um, bucket which can easily be financed, right? And whosoever avails under this, they can go to respective banks because we have now onboarded 25 lenders, including SIDBI is one of the lenders. And if they get covered under this, then there is a 2% interest subvention which they can avail of. So this is one approach which has been adopted. In SIDBI, we have like two schemes, very clear schemes. So one is 4E, which is end-to-end energy efficiency. That is for existing enterprises, largely going for energy efficiency. And the other is green finance scheme, which subsumes all the green financing requirements. And funded by us on the direct side. But the most important thing besides exposure, as I mentioned earlier, is and to remove risk perception is having risk sharing facility. We have created a pilot, but we are looking at scaling it up in terms of enhancing the corpus, not only for 2, 3, 4 wheelers, but for the ZET and bus segment if it works out the way we are working out with different stakeholders. So if these two things can happen, the issues of risk being there and the placement and replacement, both things can be attended to. So I would request the aspirants and the stakeholders keep involving the bankers from the very beginning, and they understand it. Okay, the things will will happen.
No, thank you so much, sir. I think that's very encouraging to hear. I know you mentioned about, for instance, the specific schemes that SIDBI has, the green lending scheme, and EVs can be a core component that people can go and raise money for. There's one interesting question that's come up in the chat, which is basically suggesting that it's not always easy for startups to get access to these risk sharing facilities. And the question is around what can be done if there is any initiative underway right now, or what can be done by them so that they can get access to different risk sharing facilities so that the cost of funding for them can be reduced over time. Would love to hear your thoughts on this as well.
Okay, so generally what happens in risk sharing facility is we have, like, for example, in the ESCO space where we have partial risk sharing facility with World Bank, there are 14 lenders who are onboarded, right? So they then, whenever they get cases, they would refer it for technical evaluation. Once, in principle, we do the technical evaluation and validation. Then they do the financial appraisal, and we give the coverage. In terms for EV, for example, again we onboard these lenders, as also we have a empaneled list of OEMs who are there, because we have to also standardize the other side of it, right? So people can approach their lenders, and if they are already onboarded as a member for availing a sharing facility, if they are not, then we can onboard them, right? So that is a simple process for applying to SIDBI. There is an online application mode, or anybody can visit SIDBI branches, or they can mail it to gcfv@sidbi.in, where the team will, we have a different thematic teams with us. So the EV team will then at it and then connect them with the right, say, branch or regional office.
No, thank you so much for that, sir, because I do understand that a lot of participants on this conversation are at the end of the day looking for funding to scale their EV-focused startups, and the kind of clarity you've given and the welcome to any SIDBI branch or reaching out online, I think will be appreciated by the audience here.
And I will also mention one more thing. We are setting up, with help of GCF, Green Climate Fund. We've got 200 million, and we are setting up a $1 billion facility, which will cover the entire green financing space, right? And here we are going to onboard AFCs, NBFC, MFI, and small finance banks as partner institutions. So similarly, the Government of India, the GIFT program has got a risk sharing facility also available. So wherever any NBFC or bank partners, they would like to get coverage under that and fund. So we can look at these aspects also by onboarding them as partner and then look at it.
Thank you, sir. That's also encouraging, and probably a conversational, Nehal, Aparna, interesting from your perspective as well, looking to cover the EV landscape further. Nehal, just shifting towards you, a critical question that comes, we've seen that you funded diverse set of customers, really going down to the tier 2, tier 3 cities and funding last mile sort of services and use cases. From your perspective, what is the biggest risk that you think still needs to be addressed for the segment, this niche yet mass, I would say niche, because it's the customer profile is such that it is difficult to bag them. From your lens, what is it that's a big barrier, and what is a solution to probably overcome that barrier as well?
Right. I think Sir pretty much covered everything in terms of the scale that we're talking about and the large overview of challenges that smaller NBFCs like us face is essentially matching the asset and the liability side, right? So for us, building an asset book is the easiest part, where we have demand on ground. We know which customers are getting empaneled with SIDBI, for example. We have a good pedigree of charging players, good pedigree of OEMs, good pedigree of logistic companies. and we're comfortable with our conviction of building a book, underwriting an EV, looking at disbursing to these customers. But do I have my liability side on the balance sheet matching that entire asset book? Do I have banks? Do I have funds? Do I have ECBs? Do I have equity guys who are equally supportive of my conviction on the asset book that I'm building? So that match of liability and asset, I think, is the biggest challenge today, because the complementary capital that we need over and above just a VC funding or a PE funding for an NBFC is the complementary capital coming from banks and NBFCs. And if they are not convinced on the quality of the book or the asset quality or the asset risk or the customer risk, it becomes extremely tough to have that capital flow downstream to our borrowers, and especially at a subsidized rate, which is the need of the hour, where this whole notion of EV being more expensive than ICE, etc., can't be broken if that complementary capital is not available. So I think Sir very rightly mentioned that the kind of schemes, funds, the GFC bit that he just spoke about would be extremely helpful for smaller companies like us who are doing the on-ground work to be deploying this capital to the last mile customer. So the biggest challenge is matching that piece with our liability to our asset. And how I wish to resolve it, of course, is by creating synergies between larger institutions and smaller institutions like us through either credit guarantee schemes, credit enhancement schemes. Co-lending, I think, is a fantastic way to share capital, share risk, and actually have us on ground deploy that capital while mitigating risk for the larger banks and NBFCs who may not have the bandwidth to go and touch base with the client directly. So I think co-lending, co-financing is probably, in my opinion, the biggest priority for us at the scale that we're operating at. And if that asset and liability side is matched, then I think we run like any other financial institution where we don't need subsidies to run a green book, right? Like then we are as mainstream as any other lender can be. So that's the goal. And I think NBFCs don't require too much innovation. I don't think we need to, follow too many innovative underwriting models or give certain kind of extreme subsidies or incentives on ground. I don't think an industry can run like that. So to bring it to mainstream, we would need that complementary capital support, and that can come through co-financing, co-lending, or even credit guarantee schemes, which in fact we have availed from SIDBI, a second loss default guarantee that I was talking about. So that's been extremely helpful. And it encourages players like us to do more on ground and to take more risk, because our risks are at some point hedged with larger institutions where we can absorb that risk. So that's the solution. Yeah.
No, thank you, Neil. That's I think you nailed a very critical point, which I have often heard people say, that financiers want standard templates to be replicated, not necessarily too much of innovation to happen. And financiers love to copy what has worked and hence what will scale. So point really well taken there. Aparna, before I come to you, I have just one more critical question for RK sir. I know he has to head out for a very senior government meeting at this minute. He's been called in for. So one question, we'd love to get your response on this before you head out, is from your perspective, what is the one big game-changing thing that can be brought in the EV landscape? Maybe it could be a policy instrument, a market instrument. In your perspective, what's that one big bet that can really help take the sector leap ahead?
So, like, there has been demand from stakeholders to put it in the priority sector buckets, the EV part. But the most important and critical, which I find, is the standardization and risk sharing facility. If it comes in along with some support on capacity building of both the sides, the demand and supply side, I think this can start ticking the right way. So risk sharing, while it is, I told it's a palette for 2, 3, 4-wheelers, but the ZET and other sides, it needs to be scaled up. Even 2, 3-wheeler one also needs to be scaled up. If that support comes in, from financing side, I think things can improve much better way.
Got it. No, thank you so much, sir. There are certainly more questions that we've gotten in our conversation related to SIDBI and how SIDBI can
You
fund
can share
startups,
with me.
etc. We'll share. Yes, sir, we'll share with you, and thank you so much for your time right now. We really
Yeah,
appreciate that.
Thank you for inviting,
Thank
and
you.
sorry everybody, like I had to just leave. Yeah, thank you. Bye.
Thank you. Aparna, back to you. I think this has been in one of our conversations that we've done earlier with you. You've had that sort of visibility to see how markets outside India that took on the electrification journey early on, how they have developed over the years. My question to you is, what have been some critical lessons that you've seen from those markets that sort of are now being used by DBS to set up their EV financing strategy for India? We'd love to get an overview. What's the best practice to adopt for India?
So thanks, Ria. Thanks. I'm glad you asked this question. Because you see, we have had the experience of looking at some of the global markets where the electrification journey, say, would have started 5 to 10 years earlier than when it started in India. So just to set a context, right? Like in 2022, actually, DBS was the first bank in Singapore and the first in Southeast Asia to join the Net Zero Banking Alliance and publish concrete targets for our Scope 3 financed emissions. So this commitment actually, includes setting targets, decarbonization targets for 7 sectors, and it includes automotive. Now, given that we have set ourselves with these targets, right, we are obviously keen to support cleaner and greener financing in auto portfolio in a calibrated manner. So, how our journey has been actually, DBS's journey started around 2019-20 when we did the first financing of the EV battery plant in Europe. Thereafter, we have supported global automakers in their electrification journey. In the downstream segment, we have supported captive finance companies with sustainability linked loans, linked to certain KPIs. So if you see from the examples that I have shared, what we do is we take a value chain, an ecosystem-led approach. And how this helps us is that we can connect the dots and whether it's raw material supplies, battery supplies in the upstream, the automakers themselves, the EV makers themselves in the midstream, and in the downstream, the dealers, distributors, the AFCs, the charging infra at the downstream level. So along the way, along the value chain, if we see certain stresses, right, we can respond or act reasonably in good time. But if we don't see this entire value chain, we will be looking at isolated cases and not respond in time. So even for the India's EV financing, right, we look at it as a full value chain or an ecosystem-led approach and not in silos. And accordingly, we come up with the financing opportunities from a corporate angle, obviously, such as, whether it's long-term project financing or ECA financing, or even short-term, sustainability-linked trade financing, receivable, supply chain financing. So really the crux for us is to see the entire value chain and identify gaps and opportunities along the way. So that's where I think is that, and the similar idea and ideology experience is what we bring from what we have seen in Europe, in China, to bring it to India and apply the same value chain led approach.
So thank you, Aparna. That's very helpful. And I mean, because you speak of value chain, one question, that we've seen in the chat that's also come up is, what would be your sort of thoughts or opinions on the setup of a charging infrastructure investment fund? I believe someone in our chat has mentioned that there is something similar in the UK. What would be your thoughts of setting up something like this in India, and what could it potentially look like?
So the charging infrastructure, actually, how it works within our automotive, within DBS is where there is a pure play charging infrastructure company, which will be actually covered by the automotive sector. But if there are existing players, like the Shells and the IOCL and, the existing, the power companies or the petroleum companies setting up their charging infra, would be coming under their purview. And obviously, when it comes to the pure play charging infrastructure companies, definitely if there is a fund which backs up, right? Because if they are startups, and banks, as sir also mentioned, as Nehal also mentioned, that banks underwriting standards are slightly more, if I may say, stricter norms, because our underwriting standards are different as compared to some of the other lenders. So any kind of some guarantee provider, payment guarantee mechanism, a blended financing kind of a support system would definitely be of help when when we come into supporting charging infrastructure in the country.
No, thank you. That makes a lot of sense, and probably is the path forward to pick up for scaling of charging infrastructure as well in the country and financing in that model. I'm going to shift towards Nehal. One critical question that we're seeing, I would say, in fact, two that we see in the chat. One is asking that, is there any insurance policy to cover finance risk? What I assume is that this is probably coming from a startup that is looking at an insurance in case of default. Would you be familiar with such an instrument specifically designed for the EV segment?
From an insurance standpoint, no. I think there are standard insurance policies available to protect EMIs for lenders that come from borrowers and therefore not repaid. You can insure those EMIs that go at a certain premium. And then there's insurance on the asset and the battery. Beyond that, specifically for EV or for EV financing protection of EMIs, no. We haven't come across any policy yet.
Got it. And another very specific question that has come in the conversation in the chat actually from the participants today is that, is there any specific mandate by RBI or Government of India or the Finance Ministry on NBFCs to fund EVs, particularly 2 or 3-wheelers or buses?
Not a direct mandate, but there's been talk around, like Sir said, to include EV in the PSL. So certain banks and larger NBFCs and SFBs have mandates to work within the PSL. So certain part of their operations and book is to be earmarked to PSL lending. But EV has not yet been included in PSL. So there's a gray area of renewable energy being included, but not explicitly mentioning EV as part of the policy. So it's not yet. But yes, there has been push on looking at how can the entire value chain for banks can become green, for which green lending becomes part of it. But it's also to do more with ESG and those kind of practices that banks and FIs have to follow per se, not really to onward lend into green sectors, if that makes sense.
Aparna, no, thank you so much, Neil. And Aparna, maybe asking this question to you as well, because you are not just governed by the Indian regulations. Like, what's really the driving force behind why are you as a global bank looking at funding EVs so intently?
So, firstly, as I mentioned, right, that as a bank, we have signed the Net Zero Banking Alliance. And DBS is known for a bank with a purpose, looking at sustainable financing, moving towards greener and cleaner financing, and pivoting our portfolio towards a greener asset book. It is not just our sector, not just automotive, but there are various other sectors within the bank which are also moving towards the greener and the cleaner kind of asset book building. In fact, we publish our results every year in our sustainability report on the progress that where we are on the glide path. So that is actually really being bank with a purpose, that we are moving towards a greener portfolio, and that is, of course, the primary objective. And then within automotive, if we have to move towards that kind of financing, right? In fact, since we're talking about ICE is on one end of the spectrum and EVs on the other end of the spectrum with zero emission, right? But we have actually looked at multi-technology. So whether hybrids, plug-in hybrids, CNG for India, and EV ultimately being the zero emission vehicle. So we have looked at this transition finance and how we can also pivot our portfolio, grow with our clients towards this Shoonya campaign or net zero kind of a campaign ultimately, right? So that is where we come from, and want to do the financing of EVs and support the
No,
EV system ecosystem.
thank you. That's very heartening to hear that it's not just about a black and white approach that's being taken as a financier. It's about taking a full spectrum approach in that sense to finance and ideally move towards electric vehicles. Another question that we see in the chat, which I think is very interesting, and I'd love to get both your thoughts on, is, and I'm just reading this out, which is basically suggesting that in ICE vehicles, asset risk is static, but EVs are dynamic with battery degradation, charging patterns really available on a real-time basis. With this kind of real-time battery analytics that is possible, why is EV financing still relying on static models of underwriting? Is that firstly the case that you see? Are you actually able to use the real-time battery data right now as a part of your underwriting models for financing EVs? Nehal, maybe starting with you, Aparna, coming to you back.
Yeah, I think, see, ideally, that's the goal. That's the goal, to understand how dynamic EVs can be and how can we monitor the performance to the T, and understand it real time. But unfortunately, when an industry is still rising, it lacks standardization. So if I have to deal with, 10 different kinds of manufacturers and then different technologies that come with it, then have underwriting mechanisms around it, and to be able to create a standard credit policy to absorb the different dynamic features that come with each manufacturer or each asset class is a little tough, at least at the scale that we're operating at today. So while the assets can be dynamic, I think the underwriting or looking at it from a financing angle can still be static. It's not to say that it overshadows the dynamic aspect of the vehicles if my financing is standard for it. Those two are completely different. How we look at it is, if the commercial vehicle is generating revenue, if it is generating revenue, what is the fixed obligation that AMU will put onto that borrower? And are they able to make that obligation on time every month for the rest of the tenure, right? That's the basic minimum expectation. Now, within that, of course, I can offer certain enhanced schemes, dynamic structures, but post seeing that seasoning of at least 1 or 2 cycles on the road, has that asset that we're calling the so-called dynamic asset spent maybe a lakh of kilometers on the road? If not, we don't know in reality how dynamic that asset really is, what that battery performance is like. So having been in the market for the past almost 5 years now and having to deal with two-wheelers, three-wheelers of literally all kinds and different OEMs, we figured that the assets are not that different from EVs, ICE vehicles. Yes, they are smarter vehicles and they rely on a different technology, but the commercial vehicle aspect of running that vehicle stays the same. There is absolutely no difference. The unit economics, in fact, also stay the same. That entire notion of EVs being more expensive is not true, because if I talk of a unit economics, in every month, an ICE vehicle would spend on finance cost, service, maintenance, fuel, right? In EV, you would basically add up all the servicing cost into the financing cost and your service cost frees up. So you're net at par within both the asset classes, be it ICE or EV. So it's really about redistributing the costs, not to say one is more cheap or one is more expensive. So that dynamic part is sort of inconsequential to our underwriting and our way of looking at the assets. And it's advised to always stay boring on the financing side. So as much static templates embedded in the system is better from a financing standpoint, and OEMs and chargers and that entire ecosystem can continue to innovate. And we are just here to support with our basic financing structures in the back.
Got it. Aparna, your lens on this?
So Nehal has covered it very well, but maybe I can just supplement a couple of points. So firstly, when you mentioned that ICE has a fixed number of years of life, to that also maybe I have a slightly differing opinion here. It's like, suppose a guy uses an ICE vehicle to go to his office and come back every day. Okay, so drives for 2 hours and that's it. But if a taxi driver is using that same ICE vehicle as a taxi, running it all day, obviously it will depreciate faster, have a shorter lifespan, right? So first and foremost, it is not always that all ICE vehicles are standard in terms of the lifespan. Coming to EVs, yes, EVs currently there is uncertainty, or rather there is certain clarifications or certain evolvement that is happening in the battery technology. Like, when we started out the battery chemistry, right, there was this NMC component, nickel, manganese, and cobalt, that goes into the battery itself, right? Or it could be an LFP battery, the lithium phosphorus ion battery. So now just assuming an NMC. So I think when over time we have seen that NMC used to be in the proportion of 811, then it came down to 622, and then it came, so even the battery technology is evolving. Uh, the manufacturers are learning, the OEMs themselves are learning on which battery would really be the which would have a fine balance between the cost, the security, the range anxiety, the range of the EV battery, the charging, how fast or slow can it be charged. So all this is not yet fixed. We don't know that which battery chemistry or which battery technology is the best and will be adopted across. So there is no standardization yet. And once that happens, then it will be based on running, right? If it is a EV taxi, on how many hours you're running, on how well it is maintained, how well it is charged. Because I believe that if you charge your EV battery up to an 80 or 90%, the battery life is better than you charging it 100%. So all this will be taken into account to ultimately decide the lifespan and the residual value, and ultimately arrive at those standard matrix to actually, undertake the financing on standardized terms.
No, thank you. That's a very relevant perspective. And that also, in a way, goes to show best practice, probably, that is yet to develop in the Indian market, which is the standardization of batteries and what that would look like. In the last 5 minutes that we have, this is really my favorite section. It's a quick rapid fire. And my request to both of you would be to give short, crisp answers, and would love to get as much covered here. Aparna, I'm going to start this one with you. Nehal, next to you. It's the same question for both of you. From your perspective, what is one EV segment that you would like to put a big bet on? Is it two-wheelers, three-wheelers, LCVs, e-trucks, e-buses? So in the coming year, what's one segment that you put big money on?
So I would think electric two-wheelers in the organized sector. The penetration rates are going up. The government push is there. The government subsidies are there. And of course, options like battery swapping, smaller batteries. So I think I would put my bet on electric two-wheelers.
Yeah, I think for me, it's four-wheeler cargo vehicles that we would place our big bets on going forward.
Got it.
Yeah.
In one word, and this is a difficult one, but in one word, what is holding back the EV finance today in the industry? And in one word, what's accelerating EV finance?
So what is holding back is again uncertainty. I know it's sounding a bit pessimistic, but yes, there is uncertainty today around battery life, residual value. But and the second question is,
what's accelerating EV finance?
Oh, so accelerating, I think the new structures or new ideas. For example, battery as a service that came, and some OEMs offered it, and it took the country by storm. And OEMs did see certain success in the early success, coming up with new structures. Because it manages the upfront cost of the battery. You can subscribe it as on a subscription basis. So I think new structures, new ideas.
For me, I think what's holding back is the pricing, and what's accelerating is the acceptability. So like Aparna said, acceptability to new models, to bringing in more standardization, and to actually understand this as an alternate energy fuel that is to rule the country going forward. So yeah.
What does EV financing need more? Speed, scale, or structure from a finance perspective?
Structure for sure, with support, government support, PPP support, public-private partners coming in. So support, so structure for sure, in my view.
I would pick a different one and say quality, because speed and scale are very dependent on quality of lenders, customers, OEMs, even the structure of partnerships that Aparna is talking about. So for me, it's quality that it needs.
And this is a question that I asked RK sir earlier, but would love your take as well. That what is that one thing that you consider will be a big game changer for the EV finance landscape in the short term?
Okay. So DBS is a very data-driven bank, and so are we in automotive. Data-driven, data around everything, and that's when we take measured approach, measured decision to lend or not to lend. So I think data-driven would be my take.
I think for me, it's co-lending, co-financing and lending schemes that can help make synergetic financing on ground with larger and smaller institution players working together. So co-lending would be my answer there. Yeah.
Nehal, just one quick request on that. There was a question that came up in the chat. If you could, in a sentence, explain what is co-lending exactly and what is co-financing. Just a short explanation there would be helpful.
Right. So co-lending is essentially a category of co-financing, which means two institutions coming together to give a loan to a specific borrower. So, for example, if a fleet company wants 100 EVs and the total loan size is, for example, 1 crore, there are two models available in the market today, a 100-0 and an 80-20 model. So 100-0 is essentially where AMU is only sourcing the customer for the bank as a business correspondent or a DSA, and they support the entire funding for the borrower of that 1 crore amount that they have. The other models existing are CLM1, CLM2, wherein you can essentially do an 80-20 or a 50-50 mix, where 20% of funding goes from me, 80% comes from the larger institution, and then we share on to certain risks, pricing, collection responsibilities, etc. So very dynamic. There's no one static template to do co-lending, but the idea is that two NBFCs or one NBFC, one bank, one FI, one NBFC come together and finance for a specific loan or release. So yeah.
Thank you for that. And just we're at time, but my final question is, and this is a one-word challenge to both of you. In one word, describe the future of EV finance in India. Aparna.
So in my personal capacity, I would want to say optimistic, but as a lender, I think I will say calibrated, measured growth.
Yeah. I have a more fun answer, which says breaking the ice, which is the internal combustion engine. So we are looking forward to doing that. And of course, like Aparna said, that kind of optimism and brightness in the future is something that we're convincing our entire business models on. So yeah, that's the goal.
Yeah. So thank you both. It's been such a pleasure to have Aparna, you and Nehal, you have this conversation with us. We've seen strong participation and interest. There are a lot of questions. We might summarize a few, share them with you as we see fit. And really want to take a minute to thank you both for your time and your patience to answer all questions so diligently and so articulate. Thank you all, and Weber, back to you to close our session for today.
Thank you.
Thanks, everyone. Thanks for a great discussion. That will just close the session. And hopefully see you next for the next webinar.